As a dentist, doctor, or small business owner, you're probably feeling the weight of balancing your demanding practice with your personal life, right? It's tough to find the time for family, to focus on your health, or even think about your financial future when you're always grinding away at work. To the Dr. Josh Cochran Show, where I'll focus on empowering professionals like you to build passive income and achieve financial independence through real estate and smart investment strategies. Each episode, you'll discover practical steps and real-world stories to help you create long-term wealth and gain more time to focus on what really matters: health, family, and freedom. You're ready to break the cycle and start living on your own terms. This show is for you. Welcome to the Dr. Josh Cochran Show, empowering wealth, health, family, freedom. Today, we have two wonderful guests, Reed and AC. Reed, would you spend a little time introducing yourself?
Yeah, sure. So I'm a dentist by trade. I bought a practice shortly after graduation, and then a year later bought a second practice, and kind of grew those to the point of having to do new construction to move our patient bases into. So kind of got my taste into real estate from that. And then I was kind of hooked after that, is realizing that the power and the benefits of using real estate as another investment vehicle. So from there, I started buying triple net properties, retail strip centers, medical office buildings, industrial. So I was kind of testing the waters on lots of different things. And then I realized that once interest rates started climbing, cap rates started compressing, it was hard to buy stabilized deals at cash flow. And so I kind of pivoted into value add real estate. So focusing more on multifamily and some development. So getting my experience in lots of different things. And Josh and I have connected over deals, underwritten deals in the past together. Unfortunately, we weren't able to get those deals done, as it happens oftentimes. But yeah, I've always asked Josh a lot of questions. Josh has very good experience, high level insight, and is just like the master at debt engineering, underwriting, and I would say tax mitigation strategies. So I always try to lean on Josh for those things.
Love it. Thanks for making time today, Reed. AC, you want to give an intro as well?
Sure. Thank you, Josh. New here, first time listening to you guys. Thank you for all the feedbacks that I'm going to get. So by background, I'm not a dentist. My wife is. When we got married, we started with one location. We organically grew. We scaled up pretty quick. Right now we have 9, very centrally focused. It's all within 30 miles radius, so organized and all. But we never did any real estate like what you guys are doing, and I really want to learn this. About 2-3 years back, I started looking into real estate in multifamily. We have a little multifamily portfolio, fourplexes, self-storage, and all that. But now, fast forward to like about 2 weeks back, we started thinking, why not have another location here where we live? All our offices are in kind of a rural area, so why not where we live in Austin? Why don't we have there? So, anyways, one thing led to the another. Now I'm thinking, why not the triple nets? Buy the land, build out 10,000 square foot or something like that. Use 2,000, 3,000 square foot for the dental office. Rest, I can lease it out. It will also help with taxes, the 469 and all. But yeah, I have this vision, but where to start and all is becoming a problem. So I just needed somebody who has done this in the past. If somebody can guide me through the ropes, how the triple net leases work, is the price they're asking is good, is the development cost they are asking is good. I have to also factor in. Whoever is going to rent, I have to give them TI. So all these expenses have to be baked in. In multifamily, I know how that works. In self-storage, I know how it works. But with triple net lease, I have kind of little bit of an idea, but I need more guidance here. So that's how I ended up here. But thank you for having me.
Well, AC, glad for your bravery hopping on today. The questions you're asking are the right questions to ask. We will dive into those. In total, you probably have about 10 hours worth of questions, but let's tackle like the ones that are like front and center in your mind today. We'll do that after Reed's questions. So, all right, Reed, you made a couple fantastic Facebook posts today, this week. And you always bring high level stuff, and I thought when I was looking at this, I was like, it'd be way too hard for me to dive into this stuff online. But if we do it in person here, it'll help not just you refine what you're already doing well, but also help a lot of other dentists who are trying to make those decisions. So, Reed, do you want to start off with your question or questions? We'll kind of go.
Yeah. So I think starting high level, I'd ask you, what is the goal of a well-designed portfolio? And then what does that look like? What's the framework? What are the buckets? What are the percent allocations?
Okay, I'm terrible at answering questions directly. I always go context, kind of high level down. So I will try to address those two. So goal of a designed portfolio. So when you think about how people make money, it's typically in a business. Okay, people don't invest their way into wealth typically. So you got to kind of think about what you're trying to do. If you're trying to grow wealth, okay, a well-designed portfolio is not going to help you. If you're trying to preserve wealth, then a well-designed portfolio is going to mitigate risk and get you those long-term, slow and steady returns, not at the same level of somebody who's trying to grow wealth. So I think fundamentally, Reed, how old are you?
32.
32. Okay. So, Reed and I met a couple times, and I just picked up on all the like success factors in Reed. Like he's his habits, how he looks at things, his track record. Like Reed is going to be very successful at whatever he does. Um, Reed, you're married, right?
Correct. Yep.
Yep. How many kids?
2
What are
so
the
far.
ages of the kids?
2.5 and 15 months.
2.5, 15 months. Okay. So Reed's in it, right? Between the children and his two businesses and his real estate, he's fully in and he handles it very gracefully. As we get a little bit older, kids start getting into grade school, right? Our choices tend to shift towards family. Not everybody, but quite a few of us. So Reed's in this window where he's got a little bit more time before he starts coaching whatever sport with his first child or activity, right? So the time to grind is like, before your kids start getting to like 6, 7. So he's in that grinding time. So when you're grinding in that time, you want to grow your businesses as fast as possible. I think what I'm going to do in the future is put together a little wealth pyramid to kind of break down like who makes wealth to kind of give clarity there. But to keep it simple today, it's like W2, okay, is probably the bottom tier in wealth building. The next building there would be like W2 who's investing. The next tier above that is going to be like a small business owner, okay, and then a small business owner who's investing, and then a small business owner who's investing and doing real estate, right? So Reed's already like on tier 5. When you start going from small to medium to large businesses, it takes a lot of your time, right? And you meet a lot of people who are very successful, and you ask about their families, and there's a family in town here, probably the wealthiest. I mean, the wife and the husband didn't like each other. The husband and the kids, like it was always tumultuous. Everyone's always suing each other. Like when you just have a business focus, that's what I've just seen anecdotally happen, right? So, Reed strikes me as like a family guy. So this is his window to grow his business and um really just do really well. You can scale it from there, but this is like the sweet spot for him. So Reed, when we talk about a diversified portfolio, my first sense is based off of what I know for you, that a diversified portfolio is something we could talk about, but in your situation, that's not something that I think is the right fit for you. Where do you where is the impetus for diversification coming from for you? Like sourcing back, like why why is that interesting to you at this point in your life?
I think diversification has always just been like one of those core staples within investing principles, right? So you can diversify across different equities, right? If you're just a stock investor, or within real estate itself, within asset classes within real estate. So I think there's this maybe a slight towards mitigating risk through diversification. So kind of spreading out your eggs into more baskets, so to speak, versus when I first started investing, it was a lot of concentrated risk because I'm putting so much into one large property. And so I've over time realized that I would like to protect, as you said, play defense a little bit more on preserving wealth rather than being so aggressive to grow it. And so that's, I think, probably why it's kind of led to that point. And now that I'm spreading out a little bit more, it's like, okay, what am I filling the correct buckets up correctly, in the right amounts?
Okay. I am going to challenge one more time, and then we will dive into portfolio. Then we'll answer the question. So my challenge is, Warren Buffett says, you can diversify your returns away, right, to average or even sub-average returns. And so another way to mitigate risk is through expertise.
Mhm.
Okay. You might worry that a recession might start and your practices might slow down. But due to your expertise at running dental practices and being a dentist, I'm sure you're going to be just fine, right? So I'm sure you are going to be just fine. Not everybody, but you. So let's dive into the portfolio discussion. But I would really recommend you kind of thinking about, I was,
Specialization,
what's up?
expertise and specialization over diversification.
Look at all the Silicon Valley guys, right?
Yeah.
Elon Musk, all these guys. None of them got rich through diversification, right? They went all in on a company, grew that company, sold shares, went all in on the next company, right? Like, and even you listen to and even those guys, when they start talking about like angel investing, right?
Mhm.
They're like, dude, angel investing's hard. Like you got to get in, like you got to be the first investor group, the first,
Mhm.
or it's not even
Mhm.
worth it. And most of these don't even work out, right? So even when they try to diversify in what they do, investing in tech companies, they don't usually make money
Don't
and
do so well.
don't do so well. So
Yeah.
so it's really about growing wealth is about focusing on your business and growing your business.
Fair enough.
Preserving wealth is about diversification. Good?
Gotcha. Gotcha. Okay.
Okay. So I'm just going to kind of ask some questions and kind of break this down as we go here. And Reed, thank you so much. I mean, Reed's super sharp, guys. Like he could teach all this, but just having another brain to bounce things off of helps. And so we'll do this today. Okay, so first part with like risk mitigation is liquidity, right? You never know what's going to happen. Yes, you can get in the chair, grind out some cash flow, but it's really nice to keep that liquidity. Who cares about liquidity? You do, right? Emergency situations for your
Yeah.
family, and then typically the bank does. Okay. Now, when people say like, how much do I need for my practice? How much do I need for this building? Like, how much liquidity should I have? If you say something like, oh, for a dental practice, right? Let's say you're doing 1 million in revenue, 100 grand or something. Okay. Well, what happens when you have 10 practices? Is it 1 million, right? Or buildings, right? So what I've just kind of noticed over the years is I just keep enough liquidity that I could bail out like a couple things, but having enough liquidity to bail out all of them makes no sense, right?
Yeah.
Okay. And then you got to look at liquidity. So we're talking about emergencies for family, emergencies like if you get injured, like Reed gets in a car accident, right? That's like the typical one. Like, okay, now you can't produce with the practices, you're bringing in other doctors, but like cash flow is going to be an issue. So that's like the big one if you as the dentist get injured. And then for properties, you just got to look at risk, right? Like profiles, as you know, read triple net, how strong are my tenants,
Yeah.
right? When are leases getting renewed? So you kind of have a sense of when you may need more cash flow than others. You got to pay TI expenses, you got to hire the broker, right? So I generally just kind of get a feel, but every year it's new,
Yeah.
right? Like I don't use a formula every year. I just kind of like I look at risk and I look at like problems I'm solving and I allocate. So having enough cash flow for the family, I think that you just don't want to have stress, right? So there's two ways to deal with stress. One is to coach yourself out of it, and we always need to do that because I find myself stressing about stuff I don't need to stress about all the time, right?
Yeah.
So what's that? But then two, let's have the cash flow that you're also not creating that situation. Um, and then liquidity. So define liquidity, right? So is it can there's different types of liquidity. So liquid is usually like 90 days or less, you have access to it, right? But if you get in a car accident, you might need it immediately. So I generally lump liquidity into baskets like I have control and I don't have control. Or yeah, that's kind of how I look at it. And then like some of
I
my
kind of
investments, oh yeah, go for it.
No, I kind of think of liquidity as um, quick access, like high yield savings account, and then something
Yep.
like an after tax brokerage account with either you could put T-bonds in if you wanted to, or stocks. And so I have to burn through quite a bit of cash before I get to that more medium liquidity, right? Or harder to access liquidity. It's kind of
Or
how I
TR,
build it out.
or it penalizes you, right?
Yeah,
Um,
depending on CDs or whatever. Yeah.
and if you're in funds too, some of the funds have like shorter redemption rights where you say, "Hey, could I get my money?" And they usually say like a 90-day window. They
Yep.
try to get to you in 30 days, like on the shorter term ones. Excuse me. So, so yes, you're right. Absolutely. I would agree with that. And then, but think of that third tier too. Okay. And then think about stakeholders. So you're the stakeholder, and the primary other stakeholder, if you're acquiring real estate, is the banks, right?
Yep.
And so assets that the banks think of as liquid are cash, right? But also
Yep.
stocks, also
Yep.
like often gold,
Okay.
some life insurance policies,
Hmm.
depending on the bank.
Yep.
So you can expand your liquidity portfolio as well, into like surrender value, life insurance, those kind of things, cash value.
Yep.
Good.
Okay.
Okay.
Mhm.
What thoughts or questions do you have on liquidity before we go to the next piece?
Um, I would agree that it varies year by year based on what risks are coming up. Like for example, this year I was facing a couple potential vacancies on some triple net properties, and so I was stacking up a little more liquidity on the off chance that that would happen. I was able to get them released, which is good, but that's kind of how I play it too, is year to year based on where I see the most risk exposure and then try to allocate more capital at that time. But I mean, the number one solution to that is having a high income where you can stack cash quickly. So that's the other hedge
That's a
where you
really good
don't have
point.
that opportunity cost
You
of
can,
having too much. Yeah.
oh, no, the solution income.
Yeah. Yeah. So that's the other thing is like, okay, I know I can save this much a month if I need to, and that can be my problem solver as well. So, but there's always that fine opportunity cost balance of having enough liquid, but not losing out on the returns of that liquidity as well. So there's always that.
For medium term liquidity, I didn't plan this last year, but I actually made the most money on lending. So it wasn't
Well,
even part of my plan. It just kind of evolved. And yeah, so that's another great like medium term option. Now with lending, it's not guaranteed you're going to get it back by a certain date, but when people need, like if they're not going to the bank, there's a reason, right? They need money quicker, or the bank just doesn't like the ratios or something, right? And so if you're bringing cash and solving a large enough problem for somebody, you can get really outsized returns on lending. So I think that rubber meets the road. That's a nice medium term.
yeah. I've
Yeah.
done some of that too, where you do
Okay.
some gap funding or whatever, and you can get a pretty good return on it.
Yeah.
Yeah,
Okay.
it's not like again, it wasn't a by design, but it's just been here's an opportunity, 3 points up front, and 20% interest rate or something. It's like, okay, it's a little riskier, but I'll take it.
I'll
Yeah,
take it. Yeah, I went through and I did like my analysis of 2024 income, right? And it wasn't until like mid-year that I started having an inkling that that might be my largest income of last year, and it ended up being so. Yeah, okay. So liquidity, I mean, we could go more on that. That's pretty good. So we
Yeah.
want to talk about portfolio allocation.
Yeah. Yeah. And yeah, that's I think the next thing. I guess that's technically a part of your portfolio is liquidity
Yep.
because it can be invested. So then we
Yep.
have two other buckets.
Yeah. So are we talking like real estate and equities or
So I think of it as like cash flow and income or like
yep.
equity and appreciation. And then within that, you could put different things within real estate that fit within those two categories.
So we have cash flow and then we have
Cash flow
equity.
slash income, and then I'd say, appreciation slash equity.
Okay.
Would you agree with those maybe titles or categories?
Yeah. Um, I always go three: cash, income, equity, appreciation, tax. Those are the three
Okay.
I usually. Yep.
Okay. So pretty much the same. We're on
Pretty
that.
much the same.
Yep.
It's always the same. It's just different words and
Yep.
different filters, models. Okay, what do you want to tackle there, sir?
All right. So what I'm guessing, I'm just gonna make an assumption, then correct me, but I'm guessing between so tax technically, is it really a bucket? Because the things that fill bucket 2 and 3, cash flow and appreciation, are going to have tax benefits with them. So is it more of I'm having tax advantage things within those buckets, or do you still consider that tax bucket separate?
Yeah, it depends what model you're using. So I always use the model problem, consequence, solution. So, like, if someone's coming to me and saying, "Okay, Josh, I want to like, how do I invest? I want to invest." I'm like, "Okay, what problem are we solving here? Are we solving for cash flow? Are we solving for like equity growth, appreciation, or are we solving for tax minimization?"
Mhm.
That's my first question.
Okay.
So, yeah, however you want to look at it.
Yeah, so we can tackle then the cash flow bucket then first.
Okay. So, are we just looking at like portfolio options that create the most cash flow?
Yeah, I would think so. I mean, this is again, if the problem is I want cash flow to replace dental income, then what are my best options and what should be my allocation
Hmm.
for this?
Okay. And I would say most cash flow comes from work, right? Work done. So whenever people are looking at cash flow, it's really going to pale in comparison to like doing actual work, hands-on active work. The people who have massive passive cash flow have either built a business to create that or they've compounded their real estate for so long, 20,
Hmm.
30 years. I always think about widows, right? Who's the wealthiest people in America? Widows, right? Back in the day when husbands drove things, the husbands built up this real estate portfolio, they passed away, and the widows just killing it with cash flow. Okay, what do you think about cash flow? What attracts you most in cash flow?
Well, that's the same thing as a hedge against risk because you have income coming in that you can allocate towards the problems that come up. So I like it as, I don't know, 50% of my portfolio roughly, I would say is I want it to be cash flow or income generating. Um, so I want that to be kind of the staple. Now I'm younger, relatively younger, so I don't mind putting more in the appreciation equity bucket, right? The appreciation bucket. Um, but I think that's the greatest way to split it. I'd probably say, if we don't put liquidity in there, I'd pay 50% cash flow, 50% appreciation in those two buckets. I'd probably separate it that way.
Yeah, I mean, I really like your mindset here. I think where people get in trouble is they focus on equity growth. And then when something bad happens, they don't have any cash, right? I think, like, I know one investor, he's been an investor primarily now for at least a decade. I think he was in the tech industry before. So he's just a real estate investor, and he barely has done anything in the last 5 years.
Just sitting on the sidelines.
Yeah, he just hasn't seen at least the last 3 years, right? Like you mentioned, like interest rates go up, right? Prices have not adjusted, or owners don't really want to adjust or have to adjust if they've got locked in interest rates, right? And so I think real estate cash flow is pretty hard to get to. I usually see about 2 deals a year, and it's usually due to some sort of family inheritance, partnership dissolution.
Okay.
Those are the two scenarios.
So are you saying cash flow is a myth? Is that what you're saying right now?
I'm saying that certain years you're going to be able to find cash flow in real estate easier than other years.
Sure. Sure. But I
And
think but I think if
yeah.
you can find it in this environment, then you got a good deal. That's only going to be gangbusters when you can refinance it.
100%.
Yeah.
So, Reed, you know this. You know that when you calculate like average annual return, right? Like 3 to 5 years is like the sweet spot, right?
Mhm.
So if you have like a 10-year project, your annual average return, your IRR is not going to be the same. Um, yeah, I mean, I have the same thoughts. If you get it cash flowing now at a healthy number, then when rates do come down, who knows when, but when they do, I mean, you're going to look like a genius, 100%.
Mhm. I
But
think go ahead. Sorry.
the problem though, right, is volume of deals, right? Like
Yes.
to be realistic to like dentists, like I look at hundreds of deals a year, like maybe 1,000 deals a year, right? And I find two cash flowing ones. Now if I only looked at deals, that's all I was doing with my time, maybe I could develop some really refined systems. And I'm sure with the advent of AI, just pulling data, I'm sure people are already starting to do that.
Mhm.
But I think that's the problem for most dentists. They look at like 5 deals and they're like, okay, which one of these is going to cash flow? And the odds are none. I don't know your thoughts. I mean, I know
Uh,
you're pretty active locally.
Yeah, yeah. So we found we've probably had 4 deals that would cash flow this year. But it also depends on your debt engineering there, right? So if you can get an interest only note for 3 years until you reposition the property, it cash flows technically. But then you have to look at what does that look like when you add back the principal payment later. So you have to make sure that you're engineering that correctly for risk. So you
Yeah.
can engineer cash flow, but you have to make sure you're doing it responsibly.
I've only seen interest only in multifamily. Have you seen interest only in retail?
I have, but you get like 1 year, right? Something like that. And typically I'll take it because I'd rather stack the cash up myself and have it and have a little bit more payment on the 25-year AM or whatever. But yeah, typically multifamily will do year, 2 years of interest only payment, 3 years sometimes.
Yeah.
Yeah.
Okay. So what questions do you want to explore within cash here?
This wouldn't be a bad segue to AC because if he's looking at potentially doing owner occupied piece of real estate, um, you kind of look at it, you can evaluate those as possible, like if you're in it versus if you bring another tenant in. So it might be a good pivot to kind of talk about that and bring AC in because that'd be a good example of focusing on cash flow versus appreciation and equity.
Love it. Great idea. AC, you still with us, brother?
Yeah, I'm here listening you guys. Thank you.
Yes. Well, you get lucky today. Read. I don't know if Reed, you haven't done ground up, right? You've done value add on retail. Okay.
I've done ground up, well, for my own practices.
You
And
have.
yep, and I've
Perfect.
done value add on vacant office, converting it into dental practice.
Awesome. Okay. All right, AC, shoot. We're here to help.
Perfect. Perfect. So, Reed, this is exactly what I'm trying to do, but if you can give me some guidance here. So, what I'm looking at is 1 to 2 acres. I've been scouting the area and found good lots, 1 to 2 acres at a good intersection. This lot that I like so far, it's right in front of Target and Costco that are being ground broken in the part of town that I live. The population has exploded in the last 10 years in this area. But anyways, back to back, there is a Target and a Costco, and right in front of it in the street and the highway and the street, actually it's not a highway, there are some acreage that are available. I'm planning on taking 2 acres out of it, but it's expensive, it's steep, it's very expensive. Those 2 acre will cost a good $2 million just for the land. Then developing it will cost a good 215 to 210 sorry 215 to 220 per square foot. So it's good, you know, two and a half, sorry, 2.2 to 4.5 million in construction. So all in, this project will cost about 6 million. It'll take about year and a half. But my question is it worth it? Am I looking something wrong? Because the rates, the base rent here, where the Target and Costco are going, it's already $55 base and then triple nets.
Oh,
The across the street, I'm hoping at least 40. So if I can do 40 for, it again, I'm using the numbers from based on what I do for multifamily or even in self-storage. I look at expense, worst case scenario, I look at 1% rule, which again, it doesn't work so much in multifamily, but it depends the age and the location and all. So it beats those. But again, it's such a big investment. It will be the biggest investment so far from given my size. So a part of me is excited. I know that area is, it's growing. It's like it's unrecognizable what it was 2, 3, 4 years, 5 years back. It was all trees. Now it's a different. So and city has lines are going, utilities are going in. So I know it will blow up, but it's a big commitment. And all of these, it's non it's going to be recourse loan. I did a little background search also. Unless I'm wrong, please read correct me. Anything under 10 million, this is not a $10 million project. So it'll be a recourse at good 7 to 8. That's another thing I wanted to know, which banks to go to. So yeah, a good recourse loan in this big project can backfire if it's not done correctly. So anyways, I just give the full 50,000 foot detail, but please tell me where things can go wrong or what should I be looking at, and everything included.
Reed, you want to start there, sir?
I can tackle it first. So, and then Josh, correct me. You're more of the development guy than me, but so you're thinking 6 million to build 10,000 square feet,
In all, let me switch on
right?
my camera.
Uh,
I don't know how to
and
do.
then roughly triple net is going to be something like 45 to 55 per square foot.
I'm low. Read, I'll lowball it. I'm thinking at least 40 to 45. 55
Okay.
is anchor site, and I'm not anchored. I'm shadow anchored. So I'll be across the street. So let's give it
Okay.
$10 break minimum.
Okay, so we'll call it 450. We'll call it 45, which would be roughly 450,000 of NOI on a triple net property. Right, Josh? You're
Uh,
tracking that so far?
you-
So
Yeah,
if
just square feet times. Yep.
if
so
so
you did
go ahead.
read.
Sorry.
Sorry to interrupt. So all you did was 45 multiplied by 10,000. You are considering. Let's take small. Let's take it's a 10,000 square foot retail, correct?
Correct.
So 45 multiplied by 10. Okay, for 450. I'm with you.
Yep. And that's roughly a 7.5 cap.
How did you get there? Because
So you take
how,
your total NOI because this is a triple net property, you have no
Mhm,
expenses. Assuming
mhm.
pretend you're not the owner occupant. Just pretend you're
Sure,
building
sure.
it and someone else is
Mhm,
leasing it from you. So your
mhm,
potential NOI when fully leased up is 450,000.
mhm.
Your all-in cost is 6 million. So
Uh-uh.
450. What?
Sorry, sir. Sorry to interrupt, sir. 6 million if it's for the two acre. But if you're doing only 10,000, I'm looking at about maybe 3.25.
Oh, okay. So that makes it even better. So you're
Yes.
saying a 10,000 square foot you really only need a little over an acre.
Yes, Reed, and that's what I wanted, somebody who has done this to give me a validation, or am I missing something? This is exactly the formula I used, because my all-in cost, land is 1 million. Let's assume I'm only doing 10,000, okay? For 2,000, sorry, 10,000 square foot, for 20,000, I'll just double it. But for 10,000 square foot, I need 1 acre land, and they have 1 acre parcels. 1 acre, 1 acre land is costing me 1 million. To do the construction, it'll cost me anywhere between 2 to 2.2. Okay, so even if it's 2.2, so 2.2 is construction till the shell building, by the way. Construction meaning entitlement, it'll include parking lots, street light, whatever necessary, and giving the shell building. From the shell, whoever takes it. If I'm a dental business, I go in, I use my own brokers and get it done. Nail salon will use its own. I'm just giving shell. So shell will cost me from dirt land to shell. It's going to cost me about 2.25. So 1 million in land. Let's say little bit over 2 million, 2.2. Let's assume 2.2 from dirt to shell building. So all in, I'm looking at 3.2, roughly about 3.2 million. Does it make sense, guys? And am I missing
Yeah.
something? Please correct me, because it will be a huge, colossal guesswork that went wrong for me.
You are missing a couple things,
Sure.
but I'm gonna let Reed follow up on his math because Reed's doing like the best, like simple way to do it, which is fantastic.
Sure. Thank you.
Call me simple, Josh.
I wish I was simple. I'm jealous of simple. Keep going, Reed. You're doing great.
Okay, so you said, so we'll say 3.2, but I'm just gonna throw a huge buffer in there. Let's call it's 4 million all in costs. I'm gonna give you $800,000 of buffer, and
Mhm.
you could throw that into TI, you could throw that into whatever you need to finish out the rest of the building when you negotiate with tenants.
Okay, I see. Because I have to give TI also. What is the calculation for TI, Read, if you don't mind me share? Like,
That's very unique. You just have to ask a broker in the area.
okay,
If you're looking at specific tenants, you're going to negotiate different leases. Longer tenants might want more TI, shorter tenants might want less TI. It's all negotiation. So you just have to ask your local broker of what's typical
okay,
for this area and this product. So I'm just going to round it up to 4 million.
okay.
So we got to an NOI of 450,000 by multiplying the lease rate times 10,000 square feet, right?
Yes,
Okay.
yes.
So 450,000 is the
Mhm,
NOI. We divide that by the all-in cost of 4 million to
mhm.
get a cap rate of 11%.
Oh, wow. Okay.
If Josh knows that's a pretty killer cap rate if you think about it like that, right?
Sexy. Absolutely.
So think about it like this too. So it's 11% cap rate. That means that if you were to lease this up, right? If you're supposed to lease this up, and you're not even an owner occupant in this space, you're gonna have a pretty good cash flow on this property. Josh was talking about cash flow doesn't exist, but
Mhm,
technically, if you get these lease rates, you would probably get really good cash flow because your debt on this is gonna be pretty competitive as well. And by debt, I mean your interest rate and terms are gonna be really good,
mhm.
especially when you come in with 9 practices and you could use owner occupied financing. You'll probably not even have to put any money down for this property or very low because you can cross
I'm
collateralize your practices.
I'm sorry, Reed. Can you repeat the last one? How can I go zero down? I didn't understand.
So, Josh, you can maybe expand on this a little bit too, but typically, if you have 9 practices, right? So, kudos to you on that. That's you've had operational success growing your practice portfolio. You have a
Thank you.
lot of income from that. You have a lot of equity. You have a lot of
Mhm,
proof of concept. So, banks are going to look favorably at that. So they're going to
mhm,
be like, wow, this AC and his wife are doing really well. They're a sure bet. And so what you can do sometimes is cross collateralize a practice or two or all of them,
mhm,
whatever your organization is, to
mhm.
help cover the risk of this endeavor, which is building this piece of real estate. And in doing
Okay.
so, they might say, well, you're going to be the owner occupant. That's a safe. You're going to be anchoring the space at,
Mhm,
30% of the space or whatever. And you're very lend worthy. They're probably going to give you low to no down payment. when you build this out.
Oh,
You might have to
really?
buy the land at first, but you're probably going to get really good financing terms because of owner-occupied financing.
Reed, I have a question there though, or a thing I want to add. These 9 locations, I don't own the real estate. It's just, the anchor sites in front of Walmart or anything. I lease them. Still, they
That's
will give
okay.
me. Okay.
Well, I can't speak for the lender, but what I would say is it doesn't really matter whether you own the other real estate because you have enterprise value within your practices.
Okay. Understood. Thank you.
Josh, would you
That
correct
helps.
me on that? Or would you add something to that?
Yeah, I have to think through that one. On the enterprise value piece. I mean, they like it. It's not they don't like it. They just want to tie everything up, right? They want to cover their butts. And
Of course.
so yeah, I have to think about that. Uh, so, on a high level AC, I think, Reed's analysis is perfect, right? That's a great, like, hey, is this interesting or is this not interesting, right? Should I allocate time there? Um, I tend to dive into the details. It's just my nature. So and I'm also a layer cake thinker. Okay. So I'm never going to be able to give you a comprehensive answer. You just keep asking questions and then we keep diving into deeper layers. Okay.
Sure, sure.
Okay.
No, this is very helpful, Reed. I thought about it, but yes, one thing I missed in calculating about the expenses was the TI. So I have to keep a good chunk. If it's a 10,000 square foot, if I'm doing $50 a TI on an average, keep aside at least 500,000, as TI. Reed and Josh, TI is given only once, right, on the shell building. Let's say a nail salon comes in 5 years later they go, some other nail salon come in, can they also cash on TI, or TI was only for the first person?
All of them will request it. But it's based on their needs. Any sophisticated business will request it. So, but you got to think about like the first tenant versus the second tenant, right? So if the second tenant comes in and the space is mostly what they want, they just need like, 30 grand to update it, paint the walls, those types of things, then you may pay less on the second time. Depends on use.
Okay, got it.
Similar
It's
use.
also, yeah, they'll consider it like a second generation space where it's already primarily built out. So they should ask for less. But you can also always say no. If you know what you have, and I
Yeah.
say I just negotiated some new leases and I said no. So you can.
Okay.
Good to allocate.
I have two more questions, Reed, Josh. First is, what is the average cost for development after the raw land? Let's say I bought the raw land. Right now, the developer is actually my friend. We live in the same neighborhood. We play golf together. I never thought I'll ask his help, and he's a very chill guy. I really relate to him. So I asked him, and he has been helping. He has his full slew. He does multifamily. He does, but I still want to. I will go with him, but I want to know what's the market rate you guys will do for building, like from raw land to shell. Is it? Am I looking at right? He's saying about 220 at the max. Is 220 per square foot? It's a good number. Do you think?
So, this is market dependent, right, AC?
Of course.
So, when I look at like construction costs in Texas versus other parts of the country, usually Texas is in the very bottom tier of cost. In
Okay.
my local market, 4 or 5 years ago, 220 would have been a really good deal. Like if you had a solid contractor who's able to cost contain, a developer or contractor who's able to cost contain, 220 would have been good. My buddies locally who've been sending me stuff like, hey Josh, I'm thinking about buying this land and building a dental building. The numbers are coming in more in the 400s now for
Oh,
shell.
wow. Wow.
So I think if your developer buddy is saying like 220, right? And you have a guaranteed max contract.
Okay. We can add a clause, guaranteed max contract, right?
Yeah, I
Okay.
think that, I mean, to me, like I'm like 220, dude. Especially
Sounds
at
good.
those rents, that's like awesome.
You think? Okay.
Yeah. I'd
Okay.
invest in that. Need a
Okay.
partner?
uh, I do solo, but I can introduce you to the next lot if you want,
No,
because
I'm just teasing AC. I'm just teasing a little bit. But
you know,
also don't
but
go ahead. Sorry, interrupted.
Sorry. Thanks, guys. My second question was lending. Like in multifamily and all, we have broker, right? Multifamily self storage. I reach out to my broker, and it's like Priceline. They have access to everybody, and they give me the deals that works for me. In commercial or triple nets, what I'm trying to do you think there are deals, or should I just go with a local bank in the city? Are they brokers?
Yeah, I mean, you want to go read or?
You go for it.
I'm going to start on the top here, AC. We're just missing a few things I don't want to skip, and then we'll get to lending.
Sure.
Okay. So typically, when you develop a building, a rule of thumb is 1/5 of the land can be building.
Correct.
Okay. Good. So if you're doing 10,000, right, you need 50,000 square feet, which is, I don't know, like 1.2 acres.
Yes.
Okay.
Mhm.
Next point is the how you figure this out is you do the math. How do you do the math? Is you download a retail ground up multi-tenant pro forma and you put in all the numbers.
Okay.
If you don't do that, you will miss stuff and then you will regret it. Okay.
Okay.
So definitely do the pro forma. It'll have some cues in there. You're like, oh, I wasn't thinking about that. Because you're right. TI definitely needs to be in there. Interest expense needs to be in there.
Of course.
Broker fees need to be in there.
Mm-hmm.
If you talk to your bank early enough, you can get TIs, interest expense, broker fees with some banks into the loan. If you
Okay.
don't mention them and you don't put them in your pro forma and you don't ask for it, they will make you pay those things in cash.
Okay.
And then your cash on cash return drops.
Okay. Fair enough.
Lending. So AC, I love retail. It is my favorite. I am currently building 125 million of multifamily.
Wow.
Why? Why, if retail is my favorite, do you think I switched to multifamily?
Maybe location. You got a stellar deal. Good interest rate. Maybe that's another thing. Agency loan.
Agency loan. It's the lending. This is a major issue, and this is going to be typically your primary issue.
Okay. With retail, the lending is always high.
A little different. So with multifamily, lending is based off of debt service coverage ratio
Mm-hmm.
and the appraisal, right? And the appraisal is looking at like occupancy rates, right? Rent growth, those types of things. So if you have decent rent and you have decent occupancy, you can get multifamily loans. It's the DSCR works, right?
Mm-hmm. Yes.
Retail is different. Retail, you have to have a tenant. Okay. Now, regionally, this will vary a little bit between the banks, but I will tell you in my region, I've talked to all 14 banks. They're all the same. They will not lend. Okay. They will only lend on leases I have signed.
Mm.
Okay. So that is the biggest problem. Get the spreadsheet, put everything in there, but that is the biggest problem you're typically solving for is yeah, that they don't want to lend on something without a lease, especially now. Okay.
Okay.
So the owner occ piece is a good strategy. Reed
Okay.
mentioned that's the best strategy. That's going to get you the best rates. Now, let me tell you a couple things about owner occ. One is most banks define owner occ somewhere between 35 and 51%.
Okay.
Okay, so they love owner occ. It's least amount of risk in their mind. They have whole buckets for it. So now most people come to me and they're like, Josh, like I don't want to build like a 5,100 square foot demo office. So I'm going to say a couple things to you. Number one, hopefully no bankers are listening. The bank is not your friend.
Of course.
Okay, because what happens, the banker leaves, who is your friend. Now the new guy comes in and he calls your loan because you're in violation because it's cash flowing, everything's great, right? But the debt service coverage, the debt covenants are based off of your value of your property, right? So if values of all debt properties drop, right? You may be out of leverage now. And it has nothing to do with you. You've paid every time, you're doing great, you have tons of cash flow, the property's cash flowing. Does that make
Mhm.
sense? Okay. So
Yes.
so the banks are not our friends. We always need to remember that, even if we have a great relationship with all your bankers and all the boards of the banks, which I do recommend. I recommend relationship with the bankers and the boards. Okay.
Mhm.
So get those great relationships, but they're not your friend. So there are gray areas you can play in. And one of the gray areas is called subleasing. Okay. So you put up 5,100 as your size of your dental practice
Mhm.
in the plan. And then at some point you sublease what you don't need to another tenant. Okay. Um,
Okay, got it.
now, you know, this is gray, right? If the bank's national, they're probably never going to find out. If the bank's local and it looks like from the outside that you guys have most of that space, right? They're probably never going to find out. But if your sign's like a little
Yeah.
sign on the end, right, and it looks like
Yeah.
you only occupy like a corner, one of your bankers might just drive by and be like, "Hey, what's going on here?" And then also the banks have usually a third party consultant that comes in and checks progress of your construction that they're paying
Mhm.
for. Um, and so your own TIs for your dental practice, if the bank were checking your own TIs, right? And the TIs are only showing like a small spot, not like 51%, the banker might pick up on that. So there are great things you can do where like oh man, self-fund the TIs, right? And so the bank's
Okay.
not involved in the TIs, or you say, hey, we're gonna build out the first half and we're reserving the second half for like year 2 or 3 when we grow, right?
Okay.
That's what I was
But
gonna
now
say.
it's year
Yeah.
two. Read, you were thinking the same thing. Now it's year two. Instead of like doing it, you'd be like, you know what? We're just doing so good in this space. We're just going to, you don't need to tell them that, but like if they ask, be like, yeah, we were doing really good in the small space and we got more efficient, so we just ended up subleasing the rest. Does this make sense?
It does. It does, Josh.
Okay.
Thank you. You gave a lot of good pointers. First of all, I would the top one you said, the I need to do a example of this, case study. So offline, if you can share with me who can help me with do the case study, if there is a service they charge or whatnot, I would like to do. Okay, back of the paper napkin what Reed just did, right? Okay, it's costing me 4 million, and then 450 to 450,000 is the income. So that's all good, but if somebody can do a detailed that the case study, that'll be great. I would like to know where it can be done with if there's a spreadsheet that I can punch in the number, if I can do it myself, or if there is somebody who can do it for me. I would be very interested. That's one. Two, bank thing. I thank you for bringing it up. I spoke with the bank, local bank, that this friend of mine who who does development all across the town. The small bank, I spoke with them yesterday. They said if it's over 50% of the retail plaza, we can get you down to 20%. But knowing that you are a dental office and all, we can still get you down to 20, but you have to be about 25%. So we have spoken about that. My concern, though, first thing you brought it up, which I didn't think about it, since it's a recourse, and correct me, I cannot have a non-recourse in such a size, right? Wherever I can. So, okay, I have to do a recourse. So, okay, if I do a recourse, which you brought it up, I didn't think about it, the valuation, all in project is 6 million. Due to any reason, 3 months, 3 years from now, COVID happens or whatever happens, and the valuation is at 5 million, I didn't know they can come and do a call. Is it safe to say collateral call or something like that? They can come and ask me to pay the difference. It may be as low as 100. If it's like a $2 million, I'm like, I'm not sitting around with 2 million in cash. I have to start doing something really quick, sell or refinance or whatever. There's a lot of different things. So I didn't know about that. So that's what you are alerting me about, right, Josh? If I understood correct.
I want you to be aware. I'm going to let Reed. I think Reed, do you want to answer this one, or do you want me to?
I mean, I could say it. Josh might be more risk adverse than me. I wouldn't be worried about it personally. It seems as soon as like you start to have leverage on banks at a certain point in time, and they want you to be successful. They might not be your friend, but they want your
Yeah,
notes to perform because it
correct.
makes them look. So, I feel like it's potential. Like if you were trying to scale and do this 30 times, yeah, you got to be careful of what Josh is talking about. But I think for a one site location, and
Hmm.
having such a good, yeah, I think it's pretty low risk that that's going to happen to you.
Eh,
And if there is some kind of, sorry, did you have something, AC?
No, no, no. You are right. That's what I was thinking. If I'm just doing one or two, like I'm pivoting, okay, I can just keep my portfolio, let's say 20% in the next 5 years is only retail, because recourse is something I have always in self storage. The reason I'm backing out of self storage is because hard to get a non-recourse loan. Multifamily is, in my opinion, I might be wrong, you guys might have different opinions. Multifamily is easier to get a non-recourse loan. Other asset classes I'm having struggle, so I spend a lot of time in self-storage, bought a few properties. I'm stepping back right now because all they care is recourse loan. But retail, actually, it makes sense. So I'm there with you. I'm just agreeing what you said. It's true. I have to be careful though. Sorry, please go ahead.
I,
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 I think
I
that you
you know, go for it.
Sorry, Josh. I'm just saying, I think what you're doing is the lowest risk possible way to
Mhm.
get into retail. I mean, that's what I always tell people. Like, if the numbers work and you are certifying that you can pay that note, regardless of whether you can lease up that space, that is
Mhm.
where the risk is within developing retail or triple net properties. It's in vacancy, and you're mitigating
Yep.
that risk by being 30% or whatever of the paying tenant
Yep.
base, right? And so it's the best way to get a foothold within retail, with as low as risk as possible. You trust yourself as a dental practice operator, like you're not
Mhm.
going to default on that lease. So that's what I would say.
Okay. I have two questions that wedges out of here. One is, what is the interest rate? I know it's a very broad stroke question, but what is the, he was quoting me 20% down, DSCR and all doesn't make sense in this. I totally understand because he's quoting me like from ground up. He'll help me from buying the land all the way to building the 10,000 or 20,000 square foot. And he was quoting me anywhere between 7.5 to 8.5. He was talking prime plus some. So 7.5 to 8.5. Is this a good rate, or you think? Uh, I don't know. What's the market like? Is it good, bad, or ugly?
Josh beats up banks all the time, so he'd be a good person to talk to.
They hate me. No, they like me and hate me. Yeah, that's a great rate for ground up construction.
Okay, good to know. Good to know. Good to know. And second question is, if it's more than 10 million, I asked ChatGPT. ChatGPT is awesome in a couple of things. I asked ChatGPT. It says over 10 million you can have a non-recourse on retail. Is it true or no? Because eventually I want to, if I want to know what's the cap. Non-recourse is what I like, but do you think they do non-recourse over 10?
For construction,
Like what I'm trying to do, I'm not trying to do it in my first bet. That'll be too much, but
yeah.
I'm just asking eventually $10 million or more, is that's where they do non-recourse, do you know?
So there's different types of banks, right? Your bank that you're trying to get to do this is going to be a local bank,
Mm-hmm.
okay? And yes, I agree they won't call you. I mean, it's a local bank. They'd have to be in severe financial issues to call you on a loan like that. When you go from local to the next level, you're not going to like the numbers they come at you with. Okay. They're
Okay.
much more expensive. They're much less flexible. They will call your loans if they feel like it. Um, I have never seen anybody, and they usually they want national like brands as with signed leases, right? They want they want a Costco signed as a tenant for them to make
Mhm.
a loan like that. Um,
Okay, got it.
so I don't think usually what folks do is they find some other type of like a life insurance or something, right?
Life insurance.
Um, and that's later on, right? Low interest rate, long term, high low loan to value, right? 50, 60%. Reed, have you seen any takeout on retail with non-recourse? I mean, insurance is the only thing I can think of. Okay. And then they're going to want long leases, right?
Okay.
And 15
Um,
here.
and you may not get that long leases on all your tenants.
So starting out, Josh and Reed, I'm in the right place, basically using a local community bank who's saying 7.5 to 8.5. It's a good start, right?
Yep.
There is no kind of a brokerage firm that helps with, just like I have in multifamily, right? So this is the best deal. Okay, sounds good. One less thing to worry for me. Otherwise, I was like, should I start shopping around? But no. Okay, good.
And you mentioned debt service coverage ratio. I've never met an underwriter. Like there's the bank, there's the relationship manager at the bank, right?
Mhm.
And some of them are right on, okay? But many of them leave out key numbers. And I've never seen a bank not focus on the debt service coverage ratio as their primary number, their one number.
Okay.
So know at the end of the day, your pro forma needs to show a debt service coverage ratio that these guys are comfortable with, 1.25, maybe 1.2 if they really like you because you're a dentist. Or the banker can say yes all day, but the underwriter is going to give it a no.
Now, these are all really good feedbacks. Really good feedbacks. Josh, if you can just point me to the direction where I can do a performa, if it's a spreadsheet that I have to do it yourself, or if there is somebody who can help me with it, I'll be really interested. That will help me next.
You have three options. Okay.
Mhm.
Option one is to do it yourself. You just Google like exactly what you want, look through a few websites, download, start doing
Mhm.
it. Okay.
Okay.
Option two is like a data analyst. Every like big real estate development company has data analysts, spreadsheet monkeys. I am one, a spreadsheet monkey that just puts in numbers. Okay, that's all they do all day. And then what they end up doing is they end up freelancing over time. Okay, that's
Okay.
option number two. And then option number three is yeah, like a developer like myself, you just pay us some money for our time and
Mhm.
you send us the data, we put it in there. And the value add piece on there is if it's not a spreadsheet monkey doesn't own typically, right? So they don't think with an ownership mindset, but a developer will. Those are your three options. So,
I think I'll go
And
with option 3, Josh. I'll message you later.
okay. Sounds
Okay.
good.
Thank you. I
there's
appreciate it.
a you might be able to do a lazy option. What I would call that is if you have a good relationship with the broker that you're going to buy the land from, and they have any experience in development, they might be able to help you a little bit, get you started.
Yes, I am going to read. I'm actually going to check with the broker, with my developer friend who does the development, and also, of course, somebody who is Josh, who doesn't know anybody here. Like the what's the right term? It's like he,
Objective.
yeah, he doesn't he doesn't know the seller. He has no skin in the game. So
Yep.
his decision will be more neutral, right? Like because
Mhm.
broker will have good terms, he will always try to, even my friend will try to, and I get it, all of those, that's I would have done the same thing. But somebody who's neutral, he will give me the raw, like you guys, these feedbacks are really, I didn't consider the things that you said. So I think I'll go with the option 3 for sure, Josh. Okay, thank you. I really appreciate it. It was very helpful, more helpful than I imagined. So thank you for
Oh,
inviting me, guys. Thanks.
AC Reed, thanks for being brave and hopping on. I love helping people. I love doing this. This is like a drug to me. I love talking about real estate deals and wealth strategies. Reed, you are so sharp. You are going to be so successful, whatever path you decide to double down on real estate or dentistry. I have no concerns there. And AC, man, 9 practices, dude. That is amazing.
crushing it.
We had 6 and I called it. I was like family time, like health, all those things. So
I called it at 2.
you called it a 2. Reed called it a 2. So you're
Yeah.
doing great already. Thanks everyone for tuning in to the Dr. Josh Cochran Show. Wealth, health, family, freedom, and commit to making this the best year of your life. Thanks, guys.
Thank you.
Thank you again, guys. Thank you.
My
Bye.
pleasure.